Hello, everyone. A very warm welcome to a webinar today to discuss a very interesting topic on ongoing and future solar tariff trends in India. The event is organized by JMK Research, a market research and consulting firm focusing on renewables and e-mobility segment. The session is supported by IEEFA, a leading think tank that analyzes issues related to energy markets, trends, and policies. The session is sponsored by LONGi, a global leading manufacturer of high-efficiency monocrystalline solar cells and modules. Quickly on the format of the webinar will consist of interactive discussion with our eminent panelists, followed by Q&A session. At the end, we will have 15-20 minutes for that session. Participants are welcome to submit their questions in the Q&A box at the bottom of the webinar window. So now on the agenda for our discussion today, as we have seen, India has seen lowest solar tariff of rupees 1.99 per unit in December 2020 in one of the GVNL tender. And after that, there is an upward trajectory that we have seen in the solar tariffs. So therefore, to understand these tariff trends, it is very important and relevant to have this discussion today with our industry experts. Some of the key points that we will discuss today are understanding the current tariff trends, what are underlying risks with ongoing tariff trends, impact of PCD and ALM related issues on recent tariffs, opportunities for risk mitigation in large-scale solar projects, and developers' perspective on future tariff trends. And to take on the discussions today, we have a very diverse mix of industry experts with us today. We have representation from leading global module manufacturer, project developers, as well as EPC contractors to share their insights and give us a holistic perspective on current tariff trend. A quick intro for experts here today. We have Mr. Pradeep Kumar, Managing Director, LONGi India, Mr. Srini Viswanathan, CEO, Vibrant Energy, Mr. Rohit Bhandari, Head Marketing and Sales Domestic Business from Sterling and Wilson Renewable Energy, Shantanu Srivastava, Energy Finance Analyst from IEEFA, and we have Mr. Gaurang Sethi, Head Bidding from Azure Power. Thank you all to be part of this discussion today. Without further ado, I would like to start with our first session with Shantanu. You first. We have released one report also today on the same topic. So Shantanu is going to present some of the key findings of the latest report on the same topic to set the context for discussion. Over to you, Shantanu.
Thank you, Jyoti. Can you see my screen?
Yes.
All right. I think this report that you've come out with, it's come at a very important time because, energy markets, not just in India, but globally are going through some of the most volatile times and uncertain times. Because initially because of the COVID-19 pandemic, then recently because of the Ukraine war, the supply chain disruptions and an increase in commodity prices have all caused an increase in the price of solar modules. And given India's ambitious renewable energy goals, both in the short term and in the long run, I think it's important to understand in the next 12 months, how do tariffs move from here? So, I'm just going to present some of the key findings from the report that we published just today. All right. So just to look retrospectively how tariffs have moved in India, solar tariffs. So from a high of almost 10.95 in 2010, which was the L1 tariff at that time, 10 years later, almost more than 10 years later, India discovered the lowest ever tariff of 1.99 in a GUVNL 500 megawatt tender, where multiple developers quoted this ultra low tariff. And the biggest reason why this tariff was quoted because there has been a constant deflation in the price of solar modules over this entire period. From this December 2020 low tariff, the L1 tariffs have been quoted almost around Feb to March of 2022. We've seen on an average a 22% increase in the tariffs. And again, the reason why these tariffs have increased is because there has been an increase in the prices of solar modules, and we'll explore some of the reasons why that has happened in the next slide. Okay, so just quickly going through some of the reasons or the factors which have led to the rise in solar modules and ultimately project cost. I've talked about solar module prices, so that is ultimately linked with commodity price hike. The prices of essential commodities such as polysilicon, Aluminium, steel, solar glass, all have been rising in prices over the last 2 years or so. All of them contributing, along with freight prices rising or shipping prices rising, contributing to a rise in the price of solar modules. Another very important development that is happening in India is the implementation of the basic customs duty, which is a tariff barrier, along with ALMM, which is the approved list of modules manufacturers, a non-tariff barrier. Both of them, so BCD is implemented as 40% on modules and 25% duty on cells imported into India. And both of them are really going to affect the tariffs quoted by developers going forward as in the next 12 months. Another major factor is the augmentation of demand the world over. So, as nations across the world are upping their game in terms of their net zero ambitions, they are increasing their renewable energy capacity targets also. Along with that, the major corporations around the world are, increasing their decarbonization ambitions, all of which is, increasing the demand for renewable energy, including solar, and increasing demand for solar modules. And in the current scenario where there has been a supply crunch, a supply-demand mismatch has been, causing another, upward movement to solar modules. Then there are other factors such as increase of goods and services tax from 5% earlier on solar modules to 12% now. There has been increasing premium insurance premium on solar projects. There are other macroeconomic factors such as there have been lockdowns in China. So I think the two major ports in China, which handle almost 90% of the trade or export of solar modules, have been in lockdown due to COVID resurgence. So that is also causing a price increase in solar modules. So with this context in mind, we thought it's important to understand through a modeling exercise how and what scenarios solar tariffs are going to move in the next 12 months. So we took a model, a model project finance model of 500 megawatt AC PV plant based out of Rajasthan, having a capacity utilization factor of 20%, debt equity split of 75-25, having a rate of interest of 8.5%, return on equity expectations of 13% across all the scenarios. And then we try to back calculate what would be the tariffs for each of these scenarios. So for us, the first scenario that we took was that modules have already been procured by developers before the implementation of the BCD. This is in before April 1st, 2022. And this is actually a fact because almost 10 gigawatts of modules have been imported into India in the Q4 of last fiscal in anticipation of the implementation of BCD. So this is our first scenario. The second scenario that we took was that developers are going to procure modules after the implementation of the BCD in the post-BCD era. And as per our modeling exercise and as per a consultation with industry practitioners, we found out that this is the best case scenario in terms that the tariffs discovered in this particular scenario are going to be the lowest. This is also the case, and the reason that we considered the lowest tariff in this case is because we believe, because in anticipation of BCD, a lot of developers have already started to ramp up their capacities. So a supply crunch that was earlier present is going to subside in financial year 2023. Along with that, there have been a lot of capacities under development of polysilicon in major exported countries across the world, which are further going to ease the pressure on the cells that are going to be imported into India and then ultimately converted into modules. So this was a second case. The third case that we considered is that modules will be imported by developers post the implementation of BCD, and these will be imported essentially. And in our modeling exercise, the tariff that we found out in this particular case was 2.95 per unit, and these are almost 21% higher than our base case or scenario one tariffs. And why we consider this particular case is because currently domestic capacity would not be able to cater to the entire demand of developers setting up capacities in India. So there is going to be demand for imported modules for some foreseeable future. And so this scenario is also important to consider. And on the basis of the procurement strategies, capital management strategies of developers, any of these three could transpire in the next 12 months in auctions being held in the country. Okay, so another exercise that we've we undertook was to sensitize the key KPIs, which ultimately decide what would be the tariffs that will be quoted by developers. So again, one of the most important things is the capacity utilization factor. In a very ultra competitive market that is India, bump up of at least even a 4 to 5 or even a 2 to 3% the bump in CUF is going to give that competitive edge to developers. And developers have been trying to import a lot of bifacial modules to get that advantage. So as per our exercise, 1%, 1 percentage point, change in CUF is going to give a plus minus 5% change in the quoted tariffs in our base case scenario. That is scenario 1. Then we sensitize interest rates. So debt is again the biggest fodder for any renewable energy project, and in an operational stage that forms almost 60 to 65% of the running cost of a particular project. So it's important that developers secure debt from the most optimum sources at the most good terms wherever they can. And in our exercise, we've synthesized interest rates, and we found that 100 bips change in interest rate is going to create a plus minus 4% change into scenario 1 tariff. Similarly, we sensitized module prices, and we found 0.01 dollar per watt change in module price is going to change the tariffs by plus minus 2%. We also sensitize return on equity, because return expectations in India on an average right now are somewhere around 12 to 13%. But depending on the investor or developer profile, these might vary. So for a developer who's very aggressive, he wants to put on the numbers, he might actually be aggressive in the bidding stage and might also want to settle down at a lower return threshold. Similarly, if you have, let's say, oil and gas major who wants to get into the Indian market to fulfill their net zero ambitions, and along with the return generation goal, they also have this decarbonization goal. They might also probably settle down for a lower return threshold. Similarly, you might have different set of investors in the market who might have different return thresholds, and depending on those return thresholds, you might have different rates that are being quoted into the tariffs. And lastly, we also sensitize debt equity ratios. So a typical debt equity split is somewhere around 75-25 debt equity. We also sensitize for 80-20 and 70-30. And in our exercise, the change in the tariffs for the base case are going to be in the range of 1%. So those were some of the major findings of the report. I would urge everyone who's interested to go through the report and find more details about all of the topics that I covered. Just as a parting note or a word of caution going forward, I think in India, policies uncertainty has really clouded the long-term plans of developers and investors, in the past. So, and now that we've, introduced a very important BCD and ALMM, these two tariff barriers. So it's important, at least from the BCD front, that the government comes out and tells, okay, going forward, this is when we are going to revise the BCD, and whether it's going to be revised first of all or not. Secondly, whether they're going to increase the gamut of the BCD itself. On the ALMM, it would be important for the industry to know whether international suppliers would be added to the list and when that's going to happen. And another important consideration going forward is that, now that you're entering into a monetary policy tightening regime across the world, debt rates, interest rates are going to increase, and it's going to affect the financing and refinancing plans of developers globally and also in India. So capital management is going to be play a very important role for developers, and also in determining what kind of tariffs are discovered in auctions in India. So I rest my case over here and I hand it over to Jyoti. Happy to take up any questions at the end of the session. Thank you.
Thank you, Shantanu, for giving a comprehensive overview of the findings of the report. For everyone's reference, in the chat box, we have shared the link of the report as well. So let's hear it out from, first of all, the project developers. So Gaurang, we would want to understand from you, what are the project developers' perspective on future tariff trends on account of ongoing ALMM related issues and surge in module prices?
Right. Sure, Jyoti. I think it was a very helpful and fairly detailed report and presentation that Shantanu just presented. I think it has sort of set the stage for the points, and I think broadly covered a lot of the key points that I would touch upon. And before I go into any more detail, I mean, I think from a developer's perspective, sometimes we tend to be biased. So I want to say that upfront, that sometimes, and especially from the from the bidding perspective, we tend to be biased towards almost always hoping that the tariffs will eventually start to go up and the market will start to correct, aligned to the high module prices that the industry is seeing, and aligned to the risks that we continue to see. But more often than not, fortunately or unfortunately, and you can look at it both ways, the tariffs have only not really gone up as much as we would have expected. And this is a trend that we have seen not just over the last 1 year, 2 years, 3 years, but ever since the utility scale bidding started back in 2013, 2014. And it has only become more competitive since the reverse auction process started. So I mean, with that sort of a conditions apply statement, I think we have already seen, just looking at the tariffs and what we expect them to be in the coming financial year. I think just looking at it from the last 1 year, we have seen tariffs go up, right? I think in the chart that Shantanu had projected, we saw from 199 to 2 rupees, they went up a little. Honestly speaking, the industry would have expected for them to be much higher than where they were. But I think that is where the competitive forces come into play. I think a big reason why the tariffs did not go up was because of the interest rate reduction that we had seen because of, and that was primarily driven by the fact that we were in a COVID situation. The government wanted to push more money into the market. Various governments and multiple governments around the world were engaging in quantitative easing policies, and all of that had led to more equity being available and also the debt costs being lower than what they would have been in a otherwise. So I think so the module price increases, the ALMM introduction was to some extent countered, at least initially, by those assumptions. And then I think also almost always since our bidding cycle will force us, the way the projects work is that we expect the projects to be commissioned in a 18 to 24 month timeline after you actually bid for them. If not more, there may be developers who will take aggressive calls around the fact that the projects will actually get delayed because of other reasons, taking the timelines to 24 to 30 months, which actually then pushes some developers to take aggressive calls around the market being a lot better 2 years down the line. And people always go in with rosy assumptions around the fact that polysilicon prices and module prices would correct. So I think those are the kind of things that people have, those are the kind of assumptions that people, and we have seen when we had seen a sub 20 or a closer to 20-cent module price was 2 years ago. So I think that is now a fact which the market and the industry has started to come to terms with and accept, and slowly started to factor into their bid assumptions. So now whether people go in with assumptions around 35-40 cents, which is a present day domestic module price, or whether they actually start to lower their module cost assumptions, assuming that domestic manufacturers will actually pick up pace or the polysilicon prices will come down. I think some of these things will start to get clearer in the next couple of bids, especially, we've just had the VCD thing being imposed, right? So I think that is going to play some role. But overall, largely, as I think, people have now realized that the higher module prices are here to stay, at least in the short term. So that I think should, and I think most importantly, the interest rate reductions have stopped. They're only going up now. I think the RBI has announced, the Fed has announced, interest rate hike. They have also made it clear that they're only going to go up again in the next couple of quarters. So that saving grace is not going to be there, and hence there should be the tariff. We should start to see an increase in tariffs going forward.
Thank you, Gaurang, for sharing your views. I have some follow-up questions, but let's get into that in the Q&A session then. Srini, my next question is for you. You have heard how it is, what are the views of a ESCOM PPA project developer? What impact on the open access developers, project developers, this ALMM imposition will have after the October deadline is there, and how the market is changing with the BCD imposition?
Thanks, Jyoti, and for getting this opportunity. I think Shantanu set the stage right in terms of where the market is pivoting to, and some of the headwinds that are up in the market. Now, I think the problems or the headwinds are pretty much a little bit harder for a CNI player or a open access player, partly because the typical timelines that we have from a point of signing a PPA to delivering the power are fairly short compared to what we have to do if we are bidding for a SECI NTPC or a large discount tender, where usually you have about 18 months timeline. So you can actually take a longer term view and have the flexibility of understanding how the cell prices will behave, some of the immediate changes in regulatory aspects, how you can plan for some of those things. But it becomes a little bit harder for a CNI player to make those decisions, partly because we are in a situation where we sign the PPA and we kind of have to invest significant DevEx well in advance to make the project shovel ready and get the project up and running as soon as we sign the PPA. So it does create more challenges. I think the last year has been a little bit rushed, partly because all of us knew that the BCD is coming into play, but what was also happening was, and then there was a ALMM, which obviously we did not expect ALMM. We expected all module suppliers. It doesn't favor one or the other. It expects all module supplier, whoever wants to do business in India, to be in a perfect situation to go and ask for an ALMM approval and be able to process that. Now that obviously has not fully happened. Today that ALMM only includes Indian module suppliers. Apart from that, BIS is also another flag I need to flag to the group, because also if you realize a lot of BIS certified modules are not the latest 540 watt peak. There are only few limited suppliers who have the 540 watt peak technologies certified under BIS. And we have seen time delays in BIS coming through. And I know there is, as we stand, if you look at I don't know, that might be definitely another research for JMK to look at, is in terms of looking at all the applications that are currently pending in BIS and how quickly that is getting processed. So those are all limits the choice in terms of, as a OA developer, we would like to go ahead and move forward. Now, of course, from a larger standpoint, it does make sense on a macro standpoint to have significant production capacity in India to be able to cater to the Indian demand and not having to rely completely on imports. That definitely is a very positive story that we need to all ascribe to. But having said that, there are these short-term shocks that we need to withstand before the macro story unfolds. And what ends up happening today is we are all today in a situation where, given that the BCD has actually come in and there is a 25% duty on cells and a 40% duty on modules, obviously envisaging a situation where we actually import modules with 40% is literally out of the question currently where the power tariffs are. There is definitely I would say there is definitely a movement towards an upward tariff, as Gaurang also alluded to. But having said that, this higher tariff withstand was not only due to modules, but also due to high inflation in steel prices, copper prices, supply chain shocks, availability. All of that kind of aggravated the situation. And considering that we are very actively providing wind solar hybrids for a lot of our customers, there is a significant amount of steel that's involved in the wind side as well. So it also does a fair bit of impact on the steel escalation. So it's not just modules, it's all over the board in terms of increased costs. But having said that, the alternate situation is the competitive pressures around kind of making sure we are growing, because the demand demand for renewables has definitely not softened. That has grown much more aggressively than some of the shocks that we have seen on the supply side. So the positive silver lining in all of this is, while there is pressure on tariffs, however higher, we would like to push ahead on tariffs to compensate for all these extra costs. There is also a significant amount of demand to capture, and especially for in CNI, we are looking at about close to 1 gigawatt of AUM right now, and keep going on that at that level of scale. Going forward, I think what would have been helpful for us and I think I could speak for a lot of CNI developers is around a transition, around having enough capacity available locally, so that we are able to transition with capacity locally. Obviously, today where we are in a situation is, if all of us are speaking to the same limited module suppliers to import the cells, do the tolling, make sure we are able to secure the modules, and obviously that is in short supply. So there is that pressure that we'll have to all learn to live with. But I hope the increased capacity that is currently being planned in the country comes online pretty quickly, and some of the elevation around the BIS, ALMM, all of that gets resolved, so that there is a more level playing field for whoever wants to be able to do business, so that as a developer we have a choice. And we would like to, if there is certainty of supply and a good relationships that's already being developing locally, we can extract that value first, but also have an option to go out and import if required, as a OA developer.
Thank you, Srini. Assuming, as even Gaurang has mentioned, in short term, everyone is certain that module prices are going to see an upward trajectory only. So what is the surge in open access tariffs that you also foresee for this specific market?
So obviously, I think it is trading too much, slightly with a very marginal increase to the large tender prices. But I think you should take it into consideration that ultimately, in the if you actually adjust for size, adjust for timing, adjust for cost of debt, all of that, then it is a very apples to apples kind of market, I would say. I think the tricky, obviously, the business models might change, the strategy might change, but a lot of these situations is what determine why some CNI tariffs are higher than some Sethi tariff. And unfortunately, we should be very careful about not painting everything in one brush. We should understand if something is a 300 megawatt project versus a 35 megawatt project, whether it's in one site, two sites, which technologies, an evacuation line building for 300 megawatt versus an evacuation for 30 megawatt, it changes the economics. Obviously, the counterparty having a sovereign rating, the debt rating changes compared to CNI. The terms of debt change. So there's a lot of these levers that we have to understand to make sure we are doing an apple-to-apple comparison before we look at it. But I would say in a larger scale, yes, it's a slight premium, you could say, but if you have to do an apple-to-apple, it seems to be more or less the same.
Fair point, Srini. Okay, let's hear it from Pradeep. You now as the very leading global supplier. What has been your view in terms of what is impact of ongoing ALMM related issue has on the sector overall and specifically on the international suppliers?
Okay. Thank you, Jyoti. I think a lot of interpretations has already happened over the call, but let me make it a little bit more clear. So we all know that it's not a secret anymore that ALMM is a kind of a non-tariff barrier to keep the check on the imports. Well, this addresses one part of the question that how to incentivize the domestic manufacturing. Well, as a global company, we also firmly believe that the government has the right intention in doing so because they need to support the local manufacturers, and also this firmly supports the Atmanirbhar Bharat mission. But at the same time, other part of the story is that India has committed becoming a net zero country by 2070, which requires a huge deployment of solar. And this is even more important considering the recent coal shortages, what we have been hearing. So in turn, such kind of barriers, I think, will also play a vital role. It plays to be critical to achieve the near-term goal of adding, say, for example, 100 gigawatt of solar by 2022, and also 280 to 300 gigawatt of solar by 2030. Now, in April 2022, I think the LMM latest version was released, and we have seen that around 55 manufacturers with a cumulative capacity of around 14 gigawatt has been approved. But what we need to clearly note is that the kind of reliability, or probably even the watt peak of modules, say for example, more than 500 watt peak modules, which can give a COF of more than 20%. Now this is very much limited. So with such kind of scarcity of supply of high output kind of a domestic modules, I think ALMM implementation for now may worsen the ongoing supply chain crisis is what we feel. Now at LONGi, we are always committed to this mission by bringing the best possible products and technology for the solar sector. And our developers also have valued this relationship till date. This is also one of the reasons why I think we treat India as the most important market for us, because we've been here for almost like 5 years and we have supplied around 7.5 gigawatt of monoPERC modules till date. What the government needs to bring out is a stable balance, probably I can tell, in solar industry by creating, say, long-term policies. We need to think India's solar growth prospects, and also we believe that the country has enough space for both domestic and international players to grow together. At the same time, we also agree that any kind of anti-dumping should be penalized. So we've been hearing the anti-dumping duties and other discussions being going on. Well, all we can tell is India needs quality products to achieve the big goal. So on a short note, I think such immediate implementation of ALMM might worsen the ongoing supply chain crisis, but if it is done on a phased manner, I think India will still achieve their own solar mission.
Thank you, Pradeep. I think everyone on board on this panel will also agree to that point. Another question that I have for you, Pradeep, is to combat these higher module prices. We are aware that a lot of project developers are also exploring the bifacial modules. So you being the biggest supplier, what do you think are the bifacial module adoption trends in India that will happen in the next 1 year or so?
Okay. So I think the answer is already there in the market, but let me specifically explain it like from our own perspective. Well, we always try to take the industry lead in standardizing many things. So for example, standardizing the wafer size, which we have done, standardizing the diamond wire cutting for monosilicon wafer. So there are many things which we have been working very closely. Now, when we have something called as a very competitive market, then the best product will only suit the requirement. Now, let me explain. Probably if we can tell an era when prior to 2020, when LONGi was not so prominently available or being accepted in Indian market. I think it was more into a poly kind of a market before the end of 2019. But from the beginning of 2020, I think India started adopting mono technology, the mono modules, and we have seen that the entire industry has shifted to this technology in very short span of time. So what I would like to probably tell is that India accepts good technologies on a very quick pace, and the adoption is also at a very fast pace. So for bifacial, if you specifically ask me, I think that we are confident that it makes a lot of sense in terms of having better LCOEs for large scale or even for small scale projects. In fact, in Middle East, we have already seen this happening, and almost all the developers are now preferring only bifacial modules, where you have issues in terms of land or wherever you need to maximize energy yields. I think this is a solution, or I can tell the best fit solution for such kind of scenarios. Now, particularly to India, I think in 2021, to be more specific on bifacial adaptability, I think whatever supplies we have done, around 3.85 gigawatt to India, I think more than 85% of our supplies were bifacial modules, which means India has already accepted this solution as a solution for future. And we and most of our friends manufacture even monofacial modules with bifacial cells, which means monofacial modules will not have a major price gap as compared to the bifacial modules in a near long run. So why will any developer try to procure monofacial modules in future? In fact, most of the suppliers would stop manufacturing monofacial modules very shortly. This is what our own predictions and this is what our own analysis is. And even the warranties are better. So year on year, what we can see is the bifacial requirements would continue to increase. Technology will definitely play a major role in maximizing the plant output. If a developer opts for bifacial modules along with, I think, single axis tracker, then generally I've gone through the report. So probably around 4 to 5% of CUF gain can be achieved, which can compensate the higher project cost in the current scenario. So in days to come, I think the market matures. I feel bifacial is the only way ahead. And India is already adopting this technology on a large scale.
Thank you, Pradeep. I believe the numbers are pretty high, 85% bifacial modules. So hopefully in 2022, the number is going to be almost 100%, surely. Thanks. So Rohit, thank you for being patient. You have heard all the panelists, the developers, the suppliers, what their say is. So you being a EPC contractor, what is your take and view on this ongoing ALM issues, how it is impacting the tariffs and all?
Thank you, Jyoti, for having me today. See, we as an EPC contractor, we always come in the last leg of the project. So as you see, project takes around 18 to 20 months for execution. We as an EPC company comes in the around maybe around 10 or 12 months later when the technology is finalized, module is finalized. So of late, what we have seen in the market is because of the ALM issue or the basic custom duty 40%, which is imposed on the modules, the developers are taking a lot of time to finalize the module. Now, what is also happening is the projects are yet to come on ground. There are certain challenges which developers are facing, whether it is in terms of local issues at site or maybe because of this GIB issue which is happening in Rajasthan. So there are a lot of projects which are stuck and which have not come on ground. So we as an EPC, we are ready with our solutions. We understand the market is evolving, the prices are changing. And if you see the global scenario, what actually is happening is US, if you know, in the month of March, they are talking about imposing countervailing duties and anti-dumping duties on neighboring markets, Asian neighboring market, whether it is Vietnam, Thailand, Malaysia. So now what actually is happening is when we talk about ALM, all the Indian modules which have to be supplied for all the domestic projects, they see an opportunity of supplying modules to global market and primarily to US market. Now, because of this issue, there is going to be a scarcity of modules, which we foresee because this is going to take a lot of time. I think by mid of next year, this decision would come. And if it happens, it is going to be on a retrospective basis. So a lot of developers in US have decided to source modules from India. And this is a very grave situation because developers in India are depending on Indian modules. And Indian manufacturers are now thinking of exporting modules to India. And if I talk about the cell capacity or the module capacity, as you know, there are various manufacturers in India, but if we talk about cell capacity, it is in the range of 3 to 4 gigawatt. And we are talking about multi-gigawatt in the range of 10 to 15 gigawatt projects, which have to happen within a year. So we really need to think about how to source modules from where the cells have to be sourced. Now, if you see what is happening on the other side is the open access projects for which this exemption has been given till October. these developers are trying to source modules from Vietnam because there is a free trade agreement which is there with the neighboring country, and they are trying to source cells or modules from Vietnam or the neighboring markets, assuming that they are going to have some sort of saving on the module pricing. So as an EPC, we are ready with our solution. We know that at which module pricing we have to come up with technology. We have worked out various models, LCV models, which depends on the module pricing, obviously. So for every shift in the module cent pricing, we know that which technology is going to be the best solution for the project. So when we talk about technology, we say that bifacial bid tracker makes sense for the project. So in Rajasthan, today, if you see, there is a bid which has happened by NTPC and which came out with tracker with bifacial module. So we know that there is a module price at which the technology shift has to happen. So we are ready with our solution. But now what is happening on the other side is developers are stuck with the module issue. So once that issue is resolved, we are hopeful that we are going to get projects. But of course, we at the other side of the table, we always see that developers are facing issues of finalizing modules, and we of course are ready with all the optimizations. So we are hopeful that some sort of a solution will obviously be worked out, but at least in a near term, we don't see that solution happening. PLI scheme, which has been announced, would take another 2 or 3 years for people to come out with high efficiency modules. So I really think that now government also has to take strong actions to make sure that modules are available in India at a prices which developers have assumed in their model, so that they would be able to meet the returns that they have expected. So that's it from my side, and I would be happy to take up questions.
Thank you, Rohit. Those are very relevant points, I must say. Continuing what you are discussing now, let's, Gaurang, I would want to answer from you, given the current situation where domestic supplies are not at all available, what are the alternate or what are the risk mitigation strategy any project developer is, planning right now?
So I think the risk mitigation options that we have are going to be limited from the point of view of, mitigating the risk of increased module prices, right? I think, and I know, so there are going to be people who are going to think about innovative financing solutions, which can allay the risk to some extent. But some of these, I think to build these into a base case scenario, that will probably not be the most prudent thing to do or will not be recommended. Sometimes competitive forces will push developers to take such calls. But otherwise, I think, we'll have to look at it from the point of view of what risks are, is it that we're trying to mitigate. So, when we think about the module costs going up and the risk from that perspective, there are companies who are looking at vertical integration going into manufacturing. We've seen Adani is already into domestic manufacturing. Tata is there in domestic module manufacturing, so they have a better control over the supply chain. Renew has thought about doing it. There are other developers who are considering doing it as well. So that's one way. Then some developers are looking at going into some sort of a framework or a tolling agreement with some domestic manufacturers. Again, I think as Rohit rightly mentioned, that it's only time will only tell how quickly the domestic manufacturing industry actually picks up, because 80% of our modules, we all know, have been coming in from China. Whether PLI will actually and all of those the capacity addition plans will actually materialize as quickly as the government wants them to. That is one big risk. So some of these things we may not be able to completely or fully mitigate at this stage, it seems. But yes, some sort of a framework agreement will help. You are still again exposed, even in such an arrangement, you are to a large extent exposed to the raw material prices that the module manufacturing partner will be exposed to. So and that is why I think financing, innovative financing solutions, be it on the equity side or on the debt side, are best left for a post-commissioning stage. So in case the project is not able to, in case the developer is not able to deliver the project on the cost that they had initially estimated, then those are the kind of things that will eventually come to the rescue of the project. Because in any case, when you are looking to finance the project, and for you to ensure that it is bankable, at least in the initial stages, those are not the kind of assumptions that you will be able to build into your model. So I think, largely you are limited from the point of view of trying to mitigate the risks on the procurement front and on the supply chain side.
All right. Yeah, please.
Was there any other risk that you had in mind that you think, because I think these are the key larger risks that the industry is currently facing, right? So some of these things, I think the other thing, which I think I forgot to mention, I think Rohit alluded to that when he spoke, is that, the domestic manufacturers, even if they do pick up, and we are all hopeful that the domestic manufacturing will ramp up. And the key thing is for them to be able to start to vertically integrate as much as possible. I know the PLI scheme is sort of incentivizing the domestic manufacturers to go down that path. And the ALMM is, in a way, as Pradeep mentioned, a non-trade, a non-tariff barrier that the government is imposing. So hopefully that will incentivize some of the foreign manufacturers like LONGi and their key competitors to actually think about setting up manufacturing in the country, right? So if the industry can push the government and the manufacturing partners towards that will be, I think, a key thing to do. But that is more of an industry policy, or an industry solution. On the policy advocacy front, maybe it is time that the industry starts to take a strong stand in terms of pushing the government to impose some sort of an export barrier, maybe. Otherwise, if the demand in China, in the US and maybe in the Europe as well, as we have heard, is starting to pick up pace, the domestic manufacturers, even if they do manage to ramp up their capacities to the extent that we want them to, they will be incentivized to actually export them outside of India, considering the prices may be higher over there if the demand is higher. So I think those are the kind of things that we as an industry will need to be mindful of, and maybe need to work more on the policy advocacy front on that area.
Gaurang, what about the lack of availability of high wattage and high efficiency modules from domestic suppliers?
Right. So I think that is something which is there for us to see. So for example, if somebody wants to set up a project right now, they will not be able to get the module at the price at which they want it from a domestic manufacturer. They will not be able to get the module at the efficiency at which they had planned in, the watt peak capacity of the module, as you mentioned. But we are again hopeful, as these companies ramp up their capacities, the new lines that they are setting up will be more attuned towards the 180 mm or the 210 mm cell size modules. At this point in time, none of them manufacture bifacial modules, but hopefully that will change. But yes, on that to happen. So it maybe in a year down the line, by the end of this year, or I think by early 2023, hopefully some of these capacities will start to come up. Again, though, I think till the time some of these modules have actually been manufactured, tested on the ground, there will still, and they start to actually generate, and we have about 6 months to a year's data at least. There will still be some risk perception in the minds of a lot of the equity investors and the bankers and the prospective lenders for these projects. So I think those are the sort of risks that we are dealing with. Some of them can be mitigated to an extent and assuaged and addressed to an extent, but I think some will gradually get addressed as these manufacturing capacities start to come up, and as some of the projects start to get commissioned and start to generate, which are focused on the domestically manufactured modules.
Right, Gaurang. Thank you. Srini, same question for you. How open access project developers are kind of mitigating or planning to mitigate these supply crunch issues going forward?
So point one is trying to see if we could delay some of our projects, partly because we understand that we are at an unprecedented time where of course, due to supply chain shocks from the Russia-Ukraine conflict and the China being pretty much shut down for a zero COVID policy, the manufacturing facilities are shut down, so the cell prices have gone up significantly, and mostly we're working with the Indian manufacturers, module assembly manufacturers, who still mainly buy cells from China because the domestic cell capacity is not really ramped up to the demand. So they're also dependent on that cell capacity and then additional steel costs and copper and all of that. So it is also, for obviously there are some projects that we have to execute, partly because we have commitments and we're moving forward with that. But having said that, are there opportunities for us to kind of delay the project a few months and be able to meet some of the savings benefit that the customer requires and also our own internal benchmarks, right? So that's definitely one that is on the cards. Second is in terms of as everyone in the market is to see how we could lock up certain, how we could go out and discuss on tolling strategies or any other, because it's also a interesting point for us to, because this, whatever we do now will be generally be the strategy going forward for all developers. So you will have to build those relationships and make sure you have those supply chains locked up in order for the delivering not only the current projects but also the future capacities. So it is that happening. Obviously, there is also all kinds of other technical innovations that we could think of. Like I think somebody mentioned, we talked about, Pradeep talked about larger bifacial modules becoming the trend. That definitely is something which kind of, we add more bifacial, add more tracker to kind of not have so much reliance on buying modules, but create more value through the design of the system. But having said that, I think it's also a good time for all of us to come together and keep engaged and see how the sector has to shape up together, because at the end of the day, at the end of the year, we will all get a scorecard as to how many gigawatts did we install, and India will be compared with the rest of the world in terms of how many gigawatts. Of course, we all know the long-term plan is aggressive, 450 gigawatts in the next 10 years, but which means you have to deliver at least at this current run rate about 30 gigawatts a year. And 1 year that you don't do it, you've lost the ramp-up rate. So we want to make sure we continue to engage with the policymakers to help us move that forward. Of course, there's a lot of other developments happening related to storage and green hydrogen, which are very welcome steps, where we are also very active in those markets, because our goal is to build round-the-clock renewables on demand. That's where we are pivoting to as a CNI platform, being able to do that. And so there's a lot of other interesting areas for us to work on and build capabilities while we hope this market corrects quickly and we're able to ramp up significant capacity in the wind solar space.
Thank you, Srini. Rohit, any kind of recommendations that you want to give to policy stakeholders?
So I would like to give recommendation to all the developers, because I can see a lot of developers are here, because see, the technology shift is happening at a very rapid pace because of this module pricing shifting from Xn to X plus 50%, which we have seen in the recent trend. There is a shift in technology which is happening. So the right technology has to be picked for the project. So we are evaluating different technology, as I said earlier. Tracker and bifacial is the technology which we should go for, because looking at the current pricing trend, that pricing trend is going to sustain in market for at least a year now. So bifacial with the tracker technology is what we are working upon with various developers at this stage, whether it is open access project or central policy project. We are currently focusing on bifacial, and with the background of executing more than 3 gigawatt projects worldwide, we know the nuances of the technology. We know how to make it really a viable solution for our customers. So I mean, we are open to discuss with our customers. Of course, this is a platform wherein a lot of developers would have joined hearing me out. So we have a solution already ready for the market. If you want to hear it out, discuss it with us. Our team would be happy to get in touch and work on those projects. So that's it from my side.
Thank you, Rohit. I think we are going to see, upward trend on a lot of bifacial projects next year onwards. So my next question is for you, Shantanu. Gaurang mentioned that there is, another other than the technology part, and there are other innovative financial solutions are there. So any innovative financing mechanisms that you want to talk about here, which can be helpful or which some of the developers have already explored?
Yeah, I think what Gaurang mentioned was very pertinent. And we've seen in the past that, at least not in construction stage, financial engineering by developers in India has been happening post COD. So we've seen refi happening. We've seen Indian developers tapping into offshore, bond markets. We've seen a number of issues, green bond issues in the offshore bond markets. We've also seen issues in the onshore bond markets. So Avada and Vector Green, they've had issues, green bond issues, very successful ones in India. So I think that's a very important way to, get those bips of 100 or 200 bips of equity returns through refinancing. Then you have, when you go to the global bond markets, you also have that non-amortization period, which actually, helps you front load equity returns. So, that is another, way or another technique which is being used by a lot of developers in India to, front load returns and bump up that equity IRRs. Then, on the equity side, I think we have InvITs that are coming up, and these are very transformational instruments, similar to yield course in the US. So we've Versant, and we also have IndiGrid. IndiGrid recently, acquired a solar project in India. So, these are good avenues for developers to recycle their capital and, have that premium and, realize return upfront, during the initial life of the project itself. Besides that, I think, going forward, we might see probably pension funds, entering into the market and, buying into projects after COD, like you've seen in developed world. So for example, Ørsted in Denmark, one of the most important ways to finance their projects, under construction projects, was through capital recycling in operation projects through a farm down approach, wherein they used to bring in, pension funds, which are long-term patient investors. Something like that probably could happen in the next couple of years in India too. And when that happens, I think that really helps developers recycle capital into their under construction capacities. So that is another thing on the equity side. Besides that, there is a lot of interest in Indian infra assets, high quality Indian infra assets from global investors, especially oil and gas companies. So we've seen Total, BP, Shell invest in Indian renewable assets, operational assets, because they want to fulfill their own net zero ambitions. And in that process, Indian market is one of the most vibrant and the most growing markets. So they actually get those net zero ambitions fulfilled along with return generation also when they're investing in Indian RE infra. So I think all of these avenues are present in India, but like Gaurang mentioned, I think we're not still there that, during the construction stage itself, we, build them into the model. And, I think that usually comes after the post-COD period.
Thank you, Shantanu, for sharing your insights. Pradeep, I have one question for you from the audience is, how do we see the growth of on the technology front, like TopCon and HJT modules, specifically with respect to India market?
Okay. So for any module manufacturer, I think product planning will be done on the basis of how this product can be optimized for the, say, for example, 4 to 5 years of time. Let me take an example. I think we rolled out the M6 wafers that was there in the market for 3 to 4 years. Then we came out with M10 wafers, and that's there in the market for already 3 to 4 years now, and then is continuing to be there in the market. Now, any kind of technology, if we are planning to do a research on, then the major intent will be how we can optimize it further, how long it can be improved in terms of efficiencies, how much of R&D investment we can do on that particular product, so that will give a better return over a period of time. Now, that's how any product has been planned for. And if you specifically ask me about TopCon and HJT, I think we invest around 5 to 7% of our total revenues in R&D. In fact, last year it was almost like 0.6 US billion investment in terms of R&D for us. Now, with that scale, I think we do have dedicated teams working with all the technologies. It's not just TopCon, it's not just HJT. I think even with the poly technology, even if you ask me, I think we might have a R&D team working on it. So for us, I think what we have seen is, I think initially we made a news that we will release our N-type, but then we stopped it because we thought that's not a product which might give better returns over a period of next 4 to 5 years, because R&D thinks that probably in another 1.5 years, the saturation level for that product will come. So in a general note, I think HJT will be something which many people will start focusing on, I think in the near future. I think everyone is working on it. For the time being, I think investing too much on new technology, which might not be giving us a better return, is something which LONGi is not doing right now. So if you ask me, I think HJT is something which will be the future in a near run.
Thank you, Pradeep. My last question, and probably a tricky one, but being the leading global supplier, we would still want to have some bit of module price forecast from you for next 12 to 18 months. Are you seeing the prices to continue upward trend, or you're thinking there might be slight correction?
Well, let me tell, because even we cannot predict the 100% accurate kind of a number, although being one of the largest suppliers, having one of the best supply chain, or I can tell integrated team, we also do a lot of predictions. And fortunately, I think past 2.5 years, the predictions have come almost true. So I would like to share my opinion, because initially in the beginning of 2020, when we were educating customers that the price will increase, I think they all started laughing at us, which then happened slowly for various factors, because by then the capacity was also ramping up and everyone was thinking, when people have so much of capacities and the demand is not so much, why will the price increase? But there are various other factors which come into picture. So with the current scenario, I think the prices will further continue to increase, and this will go on till end of this year. And next year, Q1, I think till January, this will continue. And after that, we can see some kind of a correction, because by then the anticipated capacities for polysilicon, I think will reach to a level where they can cater to the demand. Because right now, we expected that this will recover from second half of this year, but we don't foresee any kind of a correction happening right now, because it is still having a lot of shortage. Because of late, even if Indian demand has come down because of the various policies, I think Latin American and the European market has picked up very strong. So that's something which will keep pushing the prices on a higher side for the next maybe 6 to 7 months time.
Thank you, Pradeep, for the precise answer. That's helpful, I think, for the audience also today. So anything on the policy front, Pradeep, that you would want to give some bit of recommendation from your side as equipment supplier?
Yeah. See, we know how difficult it is, or probably what are the challenges it is when it comes to putting up a manufacturing base, whether it is in India or in any other country. So if it is pertaining to policies, I think the solar industry on a whole has to be taken in a very holistic way. And it's not just the BCD or LMM which will make manufacturer probably ramp up the capacities in India, because there are multiple other factors, as I mentioned. Say, for example, for all the Indian manufacturers, 40% BCD might be a kind of support which government can give. Parallelly, even if the PLI schemes, they can incentivize a little bit to some extent, not to the extent of how we get it on a large scale. So how will the capacity come up? I think what India has to do, probably from my perspective, is that initially, I mean, technology import is also not so simple. I mean, it takes a lot of efforts, a lot of investments, and it takes a lot of time as well. So it has to be a gradual change in policy, and the policy which changes, I think, has to be very much stable. To give an example, I think to start with, since we don't have the backward integration more in India, I think what the government can think of is make the duty for cells at 0, so that the domestic manufacturers can import cells and then do the modules in a way. I mean, like with 40% of BCD for the modules, module import will obviously come down, but the cells import will further continue, so that the local manufacturing will continue to grow. And then down the line, I think once the PLI scheme starts incentivizing the local manufacturers, I think the government also has to think upon creating PLI schemes, not just for modules or cells. I think even for the other products like your aluminum frames or the silicon or whatever is required for making a solar module in. So it's not just about cells, wafers or modules. I think it's for all the materials which is needed for making a module. So that's something which, if done in a right way, I think in a staggered manners, I think slowly the pickup will happen. Because even if you see earlier, the technology and all the scale was in Europe. So how the entire thing changed to China? I mean, it's majorly because of the stable policies and slowly change in terms of the policies. And I mean, they don't change very often. I mean, it's not like we create a policy and then all of a sudden everything will change. They make gradual changes so that even if there is a plan which is coming up based on the earlier policy, that will not be affected too much. So things will continue to grow further. So PLI schemes for the entire supply chain plus a slow change in policy, I think will be the way forward.
Thank you, Pradeep. I completely agree to that point. And to summarize our whole discussion today, yes, in short term, the module prices are going to go up. And to combat these high prices, I think financial engineering and technology innovation is what is required. And then probably from 2023 onwards, Q1 of 2023 onwards, we might see some slight correction in module prices. So I think in terms of policy level advocacy, some of you have shared, is there has to be clarity on the BCD implementation that is there, clarity on the ALMM listing, whether international suppliers are going to be part of it or not, so the developers can plan their projects well ahead in time. And I think one interesting point that Gaurang has mentioned is if domestic suppliers are going to export majority of their volumes to the other international countries, they will be scarce in domestic markets. So some bit of barriers to stop that and to cater to the domestic market first can be looked up by the government. And with that, I would like to conclude this session now. Thank you, everyone. Thank you to all the panelists for sharing your wonderful insights with us today. The recording of this session will be available on our website shortly. Thank you, everyone. Have a very good day.
Thank you.
Thank you very much.
Thank you.
Very much.
Thanks.